All right, welcome back. We're watching the banks today after those stress tests yesterday. The stock slightly higher after all 31 of the banks showed they were able to withstand a severe recession scenario. This comes as they prepare to release their capital return plans tomorrow. Joining me now is Mike Mayo, Wells Fargo. It's good to see you. Thanks for coming out here. You say that these stress tests were tougher than expected. In what sense?
Well, I'd summarize the toughness of the Fed stress test as the three C's. The first C would be credit card losses were higher than they were before. The second C was commercial loan losses. I think it was the highest ever in the Fed stress test. And the third C, which is kind of surprising, is costs. Costs were quite a bit higher, even though fees are lower. And the Fed kind of extrapolated 2023 results forward. I think that was an unusually low level for fees. Whereas the year before that, they extrapolated kind of high level. I think the truth is somewhere in between. But costs kind of dinged several banks, such as Goldman Sachs.
The other thing that stuck out to you was another C, if you will, and that's Citi, which is your number one pick. You say they did especially well?
Who would think that we'd be mentioning Citigroup, Fed stress test, and a good result in the same sentence? Like, wow, after those times when Citi failed the Fed stress test. I was on your show, I think, after one of those times calling for some, management accountability. But here, Citi...
To say it mildly.
But here, Citi, like, that was a surprise that we estimate they have 30 basis points lower capital in the future. And that's the best of the bunch from what we saw yesterday. I think I was right for the wrong reason, though. I thought I'd be right because they've exited a lot of consumer business outside the United States. And as you simplify, it pays dividends, literally and figuratively. But the reason is their revenues, especially their fee revenues, are deemed more resilient than others, at least on a comparison basis, and they benefit from that. So you're finally seeing the Fed give recognition to some of those powerful fee revenue streams, such as their global payments business, which I estimate that one business line is worth the entire market cap of Citigroup. So buy one line of business, get the other four almost for free at Citigroup.
You say that Bank of America had disappointing results. Why?
Well, it comes down to some of the loss assumptions, some of the expense assumptions. The regulators require about 70 basis points higher capital out of Bank of America. But if you zoom out a little bit, Bank of America, I estimate they had $30 billion of excess capital after this test. They have $20 billion of excess capital, piling on about $14 or $15 billion of excess capital a year. So it's different shades of gray. So it's not going to, you shouldn't change your buy or sell decision based on that result.
Well, do they need to change? Would they change their buyback or dividend type decision based on that result? Because, I mean, ultimately, that's what we're looking ahead to potentially tomorrow. Who says what?
Absolutely. And I think nothing changes in terms of a material increase in buybacks at banks from the first half this year to the second half this year and into 2025.
For everybody. Nothing changes.
Maybe it slows on the margin for a few. But remember, the Fed used year-end data. First quarter bank results were really good. And they built up capital and rates have come down. And so you'll see a benefit to the capital ratio. So in the end of the day, the Fed is requiring about 0.5% more capital for banks, and banks' capital ratios are up about 0.5% year over year. So you're kind of in the same place, but all banks have somewhere between 3 and 30% of excess capital as a percentage of market cap. So you're in a good place. And don't miss the big picture here. The Fed threw the kitchen sink at the banks. This is a scenario that's worse than the global financial crisis. You're talking about 8% decline in GDP. 10% peak unemployment, 40% decline in commercial real estate from these levels. I mean, everything's going south at the same time in this test. And after applying that test, banks have enough excess capital equaling to 10% of their market cap. So the banks, U.S. banks, are in a very good, resilient place.
Why is Goldman Sachs today down 2% on the other side of these results, which you declare to be worse than expected?
So I love and hate the Fed stress test. I love it because it shows the banks are much more resilient. Remember the global financial crisis? Banks are prepared for a tail risk like that. That's fantastic. But I hate the fact that it's a black box and you have such volatile results. Goldman Sachs got a reprieve last year, and they're going back to where they were 2 years ago. They're in the Fed stress test versus last year. The revenues are down, and the expenses are up over 10%. Like, that's not the way Goldman Sachs has acted in the past. But look, it's better to be conservative than not. But in the scheme of things, that was a little surprise from my standpoint.
What gets the bank stocks in general to do better? They're up 8.5% year to date. Adam Parker, who you mentioned earlier, he was sitting in the seat in which you are now, suggesting he doesn't like the bank stocks. And he says when times are good, they do less than the rest of the market. And then when times are bad, that's when they feel it. So it's sort of like you're kind of damned if you do, damned if you don't.
You're at a tipping point here for the banks. I said this at the start of the year. I said July 1st, around then, is the tipping point for the banks. That's when you start seeing an inflection in their net interest income as you go in the second half of the year. Operating leverage goes from negative to positive. EPS growth starting the fourth quarter of this year goes from negative to positive. You're looking at 3 years of negative earnings growth, down 20% for the 3 years ending this year. And then for the 2 years after that, earnings should be up by 1/3. And by the way, about half of that 1/3 EPS increase is somewhat baked in due to the fixed asset repricing that's on the bank's book. So stay tuned. I'll be back in the second half of this year. We're going to look at that inflection. And where go earnings? That's where stocks follow.
All right, we'll check in with you. Mike Mayo, thanks for coming out.